Chapter 12, Partnerships. Whenever two or more people act as if they were in business together, then a partnership is deemed to exist. The equity section of a partnership will differ from the equity section of either a corporation or a sole proprietorship. The partnership equity section includes a separate capital account for each partner. The characteristics of a partnership include limited life, mutual agency, unlimited liability, co-ownership of property by all partners, and no separate partnership income taxes, though the profit or loss will flow through to the individual partners and appear on their individual personal tax returns. A partnership can exist even without the presence of a written or signed partnership agreement. In the event that a written partnership agreement does not exist, then the Uniform Partnership Act will provide guidance for the management of the partnership. Typically, a partnership agreement will include the rules for managing the partnership. Typical clauses will include a method for dispute resolution, profit-loss sharing ratios, rules for admitting new partners to the partnership, limits on the amount of withdrawals that a partner can make from the partnership each period, the initial contribution that must be made by each partner, the approach for valuing individual contributions to the partnership, such as tangible assets, and a listing of the rights and responsibilities of each partner. There are several different kinds of partnerships and partners. Basically, partners fall into two categories. You have general partners and limited partners. The general partners is or are usually in charge of making management decisions and are last to share in profits or losses of the partnership. The general partners also must carry the burden of unlimited personal liability for the debts of the partnership. A limited partner is entitled to share in the profits and losses of the partnership, but unlike the general partners, the limited partner does not share unlimited liability for the debts of the partnership. In a general partnership, all partners are general partners. In a limited liability partnership, the general partners are not personally liable for the malpractice or negligence of the other partners. This form of partnership is usually most appropriate for very large partnerships where some of the partners may work in very diverse locations and in fact may not even have met each other in some circumstances. Most of the large accounting firms in the United States are organized as LLPs, or limited liability partnerships. The limited liability company is a legal entity that must file articles of incorporation. Although technically a corporation and not a partnership, the LLC can elect to share its profits and losses with the members in the same way as if it were a partnership. In this way, the LLC can avoid the problem of double taxation that normally accompanies the corporate form of business. The subchapter S Corporation, or S Corp for short, is a special form of the corporation that is limited to 100 shareholders. It has all the legal characteristics of a corporation, but the profit and losses pass directly through to the shareholders, as if it were a partnership. One other unique characteristic of the S Corporation is that ownership is limited to U.S. citizens only. Match the accounting terms below to their proper definitions. Generally, when a partnership is first formed, the partners will each contribute some form of capital to the business. Sometimes it is different kinds of assets, such as land, a building, a vehicle, etc. But in many cases, each partner contributes cash into the partnership, and we need to establish a separate capital account for each partner. Sometimes the new partners contribute something other than cash. In such cases, debit cash and the appropriate asset account for the fair value of the asset that was contributed by each partner. In this example, Bright and Gonzalez form a partnership. Bright contributes $15,000 cash, inventory with a market value of $40,000, and an accounts payable, likely related to the inventory, of $80,000. Bright also contributed some computer equipment that had an original cost of $80,000, accumulated depreciation of $20,000, and a market value of $55,000. Prepare the entry to record Bright's contribution to the partnership. Well, this is what the contribution would look like. Each of the assets are recorded at their market value. Note that we ignore the cost and accumulated depreciation of the computer equipment. In addition, the accounts payable of $80,000 that is likely related to the inventory must also be added to the partnership books. The remainder is $30,000 of credit to Bright's capital account. For the same partnership, Gonzalez contributed cash of $2,000 and office furniture that had a market value of $18,000. The furniture had an original cost on Gonzalez's books of $20,000, along with accumulated depreciation of $1,500. This is how we would prepare the entry to record Gonzalez's contribution. As with Bright, the assets are debited on the partnership's books for their market value. Then, since there are no offsetting liabilities, the full amount of the assets contributed are reflected in the capital account of Gonzalez. Steve and Mac form a partnership. Steve contributes $1 million cash and land with a market value of $10 million. The land had an original cost of $7 million. Prepare the entry to record Steve Lewis's contribution to the partnership. Again, this is what that would look like. Basically, record the cash for what it is, record any other assets for their market value, and ignore depreciation or original cost. Mac, the other partner, contributes cash of $3 million and equipment with a market value of $800,000. So his journal entry to record his contributions looks like this: debit cash, which is an asset, debit equipment for the market value, which is an asset, and the balancing credit entry will be to Young's capital account. The primary difference between a partnership's balance sheet and the balance sheet of any other entity is the equity section. The equity section of any partnership will show a separate capital account for each partner. In Exhibit 12.3, Bright and Gonzalez will end up, after recording their contributions, with assets of $130,000. This will include the cash that was contributed along with the inventory, computer equipment, and office furniture. The balance sheet will also show the account payable contributed by Bright. Finally, the equity section will show a separate capital account for each partner. In a corporation, any profit goes to retained earnings. If the board of directors so decides, then some of those profits can be distributed to the shareholders in the form of dividends. However, in a partnership, there are no shareholders. By definition, all profit from the partnership will be allocated to the various partners. In a partnership, profits and losses may be allocated based on negotiated rules. In the simplest case, profits and losses will be allocated to partners based on a negotiated profit-loss sharing ratio. In more complex cases, a portion of the profits is first allocated to various partners unequally before profits or losses are allocated based on the negotiated profit-loss sharing ratios. In the example shown here, interest is first assigned to each partner based on their capital balances at the beginning of the period. Any interest that is allocated reduces the amount of profit that may subsequently be allocated based on the profit-loss sharing ratio. Next, a compensation amount or bonus is sometimes allocated to some of the partners, based on the amount of work they did within the partnership. This allocation also reduces any amounts that are to be allocated to the partners using the profit-loss sharing ratio. Let's first look at a simple allocation of profits to the partners. Bright and Gonzalez earlier formed a partnership to develop a golf course. Bright and Gonzalez agreed to allocate 2/3 of the profits and losses to Bright and 1/3 of the profits and losses to Gonzalez. If the partnership had $60,000 profit for the year, how much would be allocated to each partner? Well, this is pretty simple. You just multiply those ratios times the 60,000, and you get 40,000 to Bright and 20,000 to Gonzalez. But how would we record that journal entry to show that allocation of capital? It would look like this. You have a debit to income summary of 60,000 and a credit to each individual capital account for the amount that they received. As stated earlier, sometimes amounts are first allocated to the partners individually and unequally based on contractual commitments prior to the application of the general profit-loss sharing ratio. Assume that Bright and Gonzalez are using the 2-to-1 ratio used in the earlier example. Per the partnership agreement, Bright will receive an allocation of $16,000 as salary for extra work that Bright has done for the partnership. Gonzalez will receive a salary allocation of $24,000. In addition, each partner will be allocated interest of 10% based on their current capital balance as of the beginning of the year. After these allocations, the profit-loss sharing ratio will be applied to any remaining balance to allocate the remainder to each partner. Bright's capital balance was $30,000 and Gonzalez's capital balance was $20,000 before any allocations are made at the end of the year. As stated, Bright will receive a salary allocation of $16,000 and Gonzalez a salary allocation of $24,000. The allocation will reduce the amount of profit loss available for allocation to $20,000 total. Next, a 10% interest allocation will be made to each partner based on their capital balance prior to the allocations. So we're going to use the capital balances before we allocated the salary allowances. So 10% of each of those gives us $3,000 and $2,000, leaving a balance of $15,000. This 15 will now be divided based on that 2-to-1 ratio we talked about before. So 7,500, well, this is what would be allocated if it was a 1-to-1 ratio. So this is a little mistaken here. But if we were using the 2-to-1 ratio, then it would be 10,000 to the one partner, 5,000 to the other partner. If we're using the 50-50 split or the 1-to-1 ratio, this would be correct. 7,500 here, 7,500 here. If the initial results of the operations had been a loss, or if the preliminary allocations had resulted in pushing an initial net income amount into a net loss position, then whatever amount was remaining to be allocated would be allocated. Along with membership in a partnership, each partner has certain rights as an owner. Among those rights are 1, the right to co-ownership of the partnership property, 2, the right to share in profits and losses as specified in the partnership agreement, and 3, the right to participate in the management of the partnership. The first 2 of these rights can be assigned by a partner to a third party without the consent of the other partners. However, the right to participate in management cannot be assigned without the approval of the other partners. Anytime the partnership team changes, then officially the partnership is dissolved and a new partnership is immediately formed with the new partners included. 2 questions must be answered. How does the new partner gain a share of the partnership, and how must we account for the addition of the new partner? Assume that Bright and Gonzalez are partners. Bright has capital of $53,500 and Gonzalez $50,500 for a total of $104,000 of capital. Bright sells 1/2 of her partnership interest to Cheryl Casca for $30,000 with the approval of Gonzalez. How would we record this transaction? Note that Casca's payment went to Bright, not into the partnership. The partnership did not actually receive more cash. Casca is buying her share of the partnership directly from Bright. In this case, we must record the transfer of a part of Bright's capital to Casca. Bright's capital account prior to Casca entering the partnership is $53,500. By allocating 1/2 of Bright's balance to Casca, the capital balances will now be properly stated. Debit Bright's capital account for $26,750 and credit Casca's capital account for $26,750. When the new partner contributes assets directly to the partnership, then we have to not only allocate an amount to the new partner's capital account, but we must also account for the inflow of new assets to the business. Assume that Casca wants to join the partnership. Bright and Gonzalez have total capital of $104,000. Casca contributes land with a market value of $52,000 to the partnership for a one-third interest of the business. How is this contribution of land recorded? After Casca's contribution of land with a market value of $52,000, the total capital of the partnership has increased to $156,000. Casca will be allocated one-third of that $156,000 in total capital. In this case, one-third of the capital is $52,000, exactly the same amount as the value of the contributed land. Then, entry requires a debit to land for $52,000 and a credit to Casca's capital for $52,000. In some cases, however, the value of the contributed asset is greater than the share of the business that the new partner is to receive. In this case, the excess is allocated to the existing partners in the form of a bonus. The allocation is made using the existing profit-loss sharing ratio. Casca wants to join the partnership of Bright and Gonzalez. Casca contributes cash of $100,000 for a one-quarter share of the business. How is this contribution recorded? The partnership capital after this new $100,000 contribution is $204,000. Casca's one-fourth share of the business is $51,000. The difference, $49,000, must be allocated between Bright and Gonzalez. According to the partnership agreement, they share profits and losses equally. Prepare the entry. Obviously, cash is debited for $100,000. In addition, we will credit Casca's capital balance for $51,000. The remaining $49,000 must be allocated as a bonus to Bright and Gonzalez. If we split that up evenly, then that gives us $24,500 into each one of their capital accounts. In other cases, the new partner's contribution has a value that is less than would be suggested by the share of business acquired by the new partner. This is often the result of a new partner bringing a valued skill or other value to the business in addition to the contribution of a tangible asset. Casca wants to join the partnership of Bright and Gonzalez. Casca contributes $98,000 cash in exchange for 60% of the business. How is this recorded? The capital is now $104,000 plus $98,000, or $202,000. Casca's 60% share of capital is $121,200. That's $23,200 more than her contribution. The difference will be treated as a bonus from Bright and Gonzalez to Casca. So we're basically just going to debit each of their capital accounts for that amount, as you see here. In this triad example, Parker and Flores have a partnership. Parker's capital balance is $40,000 and Flores' capital balance is $20,000. The two partners share profits and losses equally. Ray Rivera wants to join the partnership by contributing $30,000 cash to the partnership in exchange for a 25% share of the business. How do we record Rivera's contribution? The new partnership has total capital of $90,000, $40,000 plus $20,000 plus $30,000. Rivera's 25% share would come out to $22,500. So you see, we have the $30,000 contributed, and we have the capital account for Rivera here, and we're basically just filling in the difference. We know this is a debit, we know this is a credit, so we know what we're missing here are credit entries to make up the difference. And as we discussed earlier, since Rivera is contributing more than what he's getting in capital credit, that goes as a bonus to the other two partners. So what you see here is the difference split evenly between the other two partners' capital accounts. Remember that we're always balancing entries. So if we know there's a debit of 30 here, a credit of 22.5 here, we know where the other entries have to go. Then we just have to figure out what are those other entries that go in there and how are they allocated. When a partner leaves the partnership, not only the ownership team will change, the exiting partner will usually receive some kind of buyout or payment when they exit the partnership. Bright, Gonzalez, and Casca have a partnership. Combined, their capital is $156,000. Bright wants to leave the partnership and will receive $53,500 upon exit. Prepare the entry to record Bright's withdrawal from the partnership. The entry will require a debit to Bright Capital for $53,500. That will close out Bright's capital account, and a credit to cash for $53,500 in payment. In this case, the payment was exactly equal to the value of the withdrawing partner's capital account. Sometimes the amount that the withdrawing partner receives will be less than the current capital balance. Essentially, the remaining capital balance of the withdrawing partner after accounting for the cash payment will be allocated to the remaining partners in the form of a bonus. Bright wants to leave the partnership, but will receive only $47,200 cash, even though her current capital balance is $53,500. Prepare the entry to record Bright's withdrawal from the partnership. The entry will require a debit to Bright Capital for $53,500. This was given to us in the facts. This will also require a credit to cash for $47,200. Again, given to us in the facts. So here we have a debit greater than the credit. We know the missing entries here will have to be in the credit side. And we know if these two are sharing equally, that we would just divide this up between the two of them. But in this case, they're not sharing equally. According to the ratios that they're sharing, we end up with 2/5 here and 3/5 here, and we're just multiplying those numbers times the difference between 53.5 and 47.2. In the final example, the withdrawing partner receives a cash in excess of existing capital balance. Essentially, a bonus is paid to the withdrawing partner by the remaining partners. In this case, Bright will withdraw from the partnership and will receive $57,200. That's greater than the $53,500 in Bright's capital account. So, based on the relative profit and loss sharing ratio between the remaining partners, we'll divvy up that difference, the difference between 57.2 here and 53.5 here, and we will basically attribute those debits to the capital accounts of Gonzalez and Casca based on the 2/5 and 3/5 profit loss sharing ratio. And that comes out to this amount here. Liquidating a partnership is a fairly simple task that requires 3 basic steps. First, sell all assets and allocate the gains, losses to the partners based on any profit-loss sharing ratios. Then, pay all partnership liabilities. Whatever's left, distribute to the partners based on their capital balances. And that's it.